On the 24th, something unusual happened inside the Comex silver market. It didn't make headlines, but if you track silver supply, this matters. Comex, the heart of global silver trading, may be running out of actual silver. And if that's true, the entire system is about to crack. To understand why, we need to look beneath the charts, the contracts, and the numbers into the vaults themselves. Comex isn't a jewelry store. It's not a refinery. It's a futures exchange, the engine room where silver is traded on paper, millions of ounces at a time, through contracts that promise future delivery. But there's a catch. Most traders never take delivery. They buy and sell paper silver, betting on price moves, never seeing a single bar. The system works, as long as everyone plays along. Yet recently, the numbers started whispering a different story. In December 2025, the registered silver at Comex, that's the portion actually available for delivery, fell below 24 million ounces, the lowest level since 2018. On the surface, that might sound like a big number, but in context, it's a flicker. Tesla alone could consume that amount in just a few months for its EV batteries. China's solar factories, even faster. And suddenly, the question becomes unavoidable. What happens when everyone asks for the real metal and there's not enough to go around? The pressure is building. Behind the trading screens, traders and analysts are whispering about something the public isn't supposed to notice. The difference between paper silver and physical silver. And it's one of those quiet secrets of the financial world, a difference so technical that most people ignore it, but so explosive that it could shatter the market. For every real ounce sitting in a vault, dozens of paper ounces exist, just numbers on screens, promises written into contracts. It's like a crowded theater where everyone holds a ticket, but only a few seats exist. As long as no one rushes for the door, everything seems fine. But the moment someone shouts, "Fire!" chaos begins. And now, whispers are turning into warnings. One trader, speaking anonymously, said, "If these inventories keep falling, we could see delivery defaults by January 2026. That single sentence, a delivery defaults, carries the kind of weight that can send shockwaves through markets. Because in a market built on trust, once that trust disappears, it's not just silver that crashes, it's the system itself. Let's pull back for a moment. How did we get here? Why is the Comex, a century-old institution, suddenly at the center of a potential meltdown? To answer that, we have to trace the story back to the structure of the market itself. Comex operates on a fractional reserve system of sorts. Just like banks hold a fraction of the cash they owe to depositors, Comex holds a fraction of the metal owed to traders. If everyone demanded delivery, the exchange would collapse, but that was never supposed to happen. In theory, few people ever wanted to take physical silver, until now. Over the past few years, the narrative around silver changed. Once seen as just another industrial metal, silver became the quiet cornerstone of the green revolution. Solar panels, electric vehicles, advanced electronics, all of them need silver and lots of it. While gold sits in vaults as a store of value, silver gets consumed, melted, layered, and soldered into technologies that power our modern world. And once it's used, it rarely comes back. So as industrial demand surges, physical supply tightens. Meanwhile, financial traders kept multiplying contracts, treating silver like an abstract number, not a tangible metal. That disconnect widened year after year. And by late 2025, the gap between paper silver and real silver had become a canyon. Inside trading circles, analysts began charting the ratio. How many paper ounces existed per physical ounce registered for delivery? Some claimed the number had reached 50 to 1. That means for every single real bar of silver, 50 promises were floating in the system. And that's where the danger lies, because a promise only works if everyone believes it can be kept. Think about it. If even a handful of large investors, say industrial buyers or sovereign funds, demanded physical silver at the same time, the system could be drained almost overnight. And then, the price wouldn't just rise, it would detach, breaking free from the paper market entirely. That's when you'd see two silvers, the digital illusion and the real thing. This isn't the first time such fears have surfaced. Back in 2021, during the so-called silver squeeze, retail investors on Reddit tried to expose this very issue. They pushed to buy physical silver, hoping to force delivery, but the system held barely. Now, though, the situation feels different. This time, it's not small traders shouting into the void. It's industry players, mining executives, and commodity analysts quietly acknowledging what retail traders only suspected. In private conferences and closed-door briefings, the question isn't if, but when? When does the paper market lose control of the physical one? Imagine it happening. A few big funds request delivery. Comex vaults scramble to find bars. Inventories drop below critical thresholds. Word leaks out. Suddenly, confidence evaporates. Traders rush to close positions, prices swing wildly, and somewhere in that chaos, one institution defaults on delivery. That's the spark. Once that trust breaks, even temporarily, no one knows how far the contagion spreads. Because silver isn't traded in isolation. It's tied into the broader web of commodities, derivatives, and global liquidity. If silver implodes, counterparties face losses, and those losses ripple outward. Banks, funds, industrial suppliers, even national reserves. And here's where it gets darker. The United States, like many nations, no longer treats silver as strategic metal stockpile material. The US once held hundreds of millions of ounces. Today, practically none. The world now depends on constant flow, from mines to refiners to markets. Disrupt that flow and you create scarcity, not in theory, but in the physical world. And scarcity has a way of rewriting rules. So what happens next? Some insiders believe the system will patch itself again, that Comex will quietly adjust its rules, allowing cash settlement instead of delivery. That means instead of giving you the metal, they'll just pay you the dollar value. On paper, it works, but in reality, it exposes the truth. There was never enough silver to begin with, and the moment that realization becomes public, the moment traders, manufacturers, and investors collectively understand that the world's largest silver market is effectively running on empty, panic becomes inevitable. Still, this story isn't just about fear, it's about transition, from illusion to reality, because every financial era eventually meets its reckoning. Gold did in 1971 when the U.S. abandoned the gold standard. Housing did in 2008 when paper mortgages couldn't match real values. And now, silver stands on the edge of its own truth moment. In boardrooms and trading floors, some are already preparing. Physical silver premiums, the extra price paid for real metal, have started creeping up again. Dealers report delays. Vaults quietly restock if they can find supply, but the public remains largely unaware. For most, silver is still that shiny gray metal used for jewelry or old coins. Few realize that a fracture in this market could ripple into energy, manufacturing, and finance all at once. So here we are, standing at the edge of something bigger than a commodity story. It's about trust, it's about promises, and it's about what happens when the promises outnumber reality. Because if Comex truly can't deliver what it sells, if those paper ounces dissolve into air, the entire illusion of abundance collapses. And when that happens, well, the rules of the market may never look the same again. Because once reality breaks through the illusion, there's no going back. Silver, for decades dismissed as a sideshow to gold, is suddenly standing in the spotlight. Not because of speculation, but because it's vanishing. Behind the scenes, the signs are everywhere. Dealers whisper about shortages. Refiners report delays stretching from weeks to months. Even mint operations, once running like clockwork, quietly reduce output. The message is silent but clear. The metal that underpins a trillion-dollar system is harder to find than ever. Governments have noticed too. In trade ministries and energy departments, quiet memos circulate with phrases like supply stress and inventory vulnerability. The solar industry, projected to consume hundreds of millions of ounces in the next decade, faces an uncomfortable truth. Expansion plans rely on a metal that might soon cost twice as much, if it's available at all. Meanwhile, at Comex headquarters, screens flicker with unusual volume. Settlement requests tick higher. A few major institutions opt for cash delivery, a euphemism for non-delivery. It's not yet panic, but it's the early tremor before an earthquake. For traders inside the market, the psychology begins to shift. The comfort of abstraction, contracts, hedges, derivatives, gives way to something more primal. Fear of being left holding paper when the music stops. Everyone still smiles on camera, insisting that markets are functioning normally. But the bids tell another story. Premiums for physical silver over futures, prices widen day by day. A quiet decoupling has begun, and when prices diverge, confidence doesn't fade gradually, it breaks all at once. Let's picture the moment it happens. A Thursday morning in January 2026, an institutional buyer requests 2 million ounces for delivery. The exchange hesitates, hours pass. Behind closed doors, officials debate whether to fulfill the contract or offer cash. News leaks. A financial outlet publishes a headline, "Delivery delays hit Comex silver." By the next trading session, silver futures surge. Retail investors rush in, remembering the silver squeeze era. Industrial users panic buy to secure supply. Within days, the difference between paper silver and physical silver explodes. 10%, then 20, then 40. That's not a market correction. That's a structural break. From there, events move faster than anyone can manage. Comex issues emergency statements assuring ample inventory. Analysts flood social media with contradictory data. But reality isn't swayed by press releases. Vault reports confirm what insiders already feared. The available supply is at historic lows. Bars are relabeled, released, rehypothecated. Financial sleight of hand to buy time. Yet time, in a confidence crisis, is the one thing you never have enough of. Markets feed on perception, and perception feeds on fear. investors watching the turmoil draw comparisons to 1971, when the U.S. unpegged gold from the dollar. Back then, the world learned what happens when paper promises exceed real assets. Now, silver is replaying that lesson, live. Mainstream outlets start covering the story. Panel discussions feature analysts arguing whether this is temporary dislocation or the end of paper silver. But deep down, the narrative has already shifted. People no longer ask about price targets. They ask where to find actual bars. Physical dealers are overwhelmed. Websites crash. Local coin shops post out-of-stock notices. Large industrial buyers quietly bid above spot price, willing to pay almost anything to keep production lines running. Every bar that changes hands tells a story of scarcity, of promises unraveling. Then, something remarkable happens. A few national mints suspend orders, citing unavailable blanks. Suddenly, the crisis that began on a trading floor is visible in everyday life. News anchors hold up empty display cases. The idea that a global exchange might run out of silver stops sounding like conspiracy, it's now the headline. By February, global markets enter what economists later call the silver detachment. Paper contracts continue to trade, but the linkage to real-world metal is broken. Spot prices on Comex read $34 per ounce, while physical bars sell privately for $70 or more. The two worlds, digital and tangible, have separated. This divergence triggers a domino effect. ETF managers face redemption requests they can't satisfy. Banks holding short positions scramble to cover. Mining companies see valuations soar overnight, while refiners operate 24 hours a day to meet demand. It's a frenzy born not of speculation, but of exposure. Regulators step in. Emergency meetings convene at the CFTC and the Treasury Department. Proposals circulate. Trading halts, settlement rule changes, temporary margin increases. But regulation can't conjure metal. You can't legislate supply into existence. And so, quietly, the financial establishment shifts its tone. What began as a denial becomes an acceptance. Physical silver and paper. Silver are now separate price mechanisms. It sounds technical, but in plain language, it means the world's biggest silver market has admitted defeat. Beyond the numbers, this moment changes behavior. Industrial users begin signing long-term contracts directly with miners, bypassing exchanges altogether. National reserves explore restocking programs, something not seen in decades. Retail investors, once mocked as stackers, become unlikely visionaries, the people who trusted metal over promise. And while panic cools, the new reality settles. Silver is no longer a passive asset. It's a strategic resource, one that defines access to energy, technology, and currency credibility. By mid-2026, analysts look back and try to pinpoint the exact trigger. Some blame speculators, others cite underinvestment in mining, but deeper voices recognize the root cause, leverage without limits. For years, the system multiplied claims faster than the world could mine real ounces. The math was always doomed. It just took one spark to reveal it. The comparison to 2008 feels inevitable. Another paper pyramid collapsing under its own weight. But this time, the fallout isn't just financial, it's material. Factories pause, energy projects stall, and governments race to secure critical minerals. A simple commodity has become a geopolitical weapon. And then, slowly, adaptation begins. New exchanges emerge, smaller and regionally anchored, demanding proof of reserve audits. Some use blockchain verification to track physical inventory. Others require full allocation before trading. Trust, once broken, has to be rebuilt ounce by ounce. Amid the transformation, one truth crystallizes. In an age of limitless digits, tangible assets command ultimate respect. People rediscover the meaning of possession. Holding something real, something heavy, finite, undeniable, feels like insurance against illusion. The economic consequences linger for years. Currencies fluctuate as investors reassess which assets are real stores of value. Gold surges in sympathy, but silver's volatility dwarfs it, soaring, correcting, then soaring again. For some, it's a disaster. For others, a generational opportunity. But underneath the price charts lies a deeper story. The collapse wasn't quantity caused by greed alone. It was born from convenience, the human tendency to prefer paper shortcuts over physical discipline. When every contract became an abstraction, accountability disappeared. The reckoning was inevitable. As 2026 closes, historians of finance begin writing their first drafts. They describe the event not as a crash, but as a reconnection with reality. Markets, they note, can ignore scarcity for only so long before nature reasserts itself. And for the people who lived through it, the traders who watched screens freeze, the workers whose factories paused, the investors who finally held the metal in their hands, one lesson endures. A promise backed by nothing is worth exactly that. Nothing. In the aftermath, new norms take hold. Exchanges adopt transparent vault audits. delivery ratios tighten, governments include silver again in strategic stockpiles. And in homes around the world, ordinary people who once ignored commodities now understand them intimately. They remember the weeks when the price of a simple silver coin doubled, not because of speculation, but because the world ran short of truth. The story ends not in panic, but in perspective. Markets survive, and they always do, but they emerge altered, more cautious, slightly humbler. Silver becomes a mirror reflecting the fragility of trust, the danger of abstraction, and the enduring strength of something real. Maybe this isn't just a silver story. Maybe it's a warning that every promise we make in the digital age still depends on something tangible somewhere. And when the tangible disappears, so does the illusion of control. Because in the end, it wasn't silver that ran out, it was belief.